This is Rohit Srivastava recording for the 4th of May 2022. I always give the date out. Everything I say should be time-stamped and well known, whether people remember it or not. We're always going to have a view on the markets and we're always going to change as we go along, and that's just going to be part and parcel of the whole thing, whether people like it or not. Because if you don't change, the markets will whack you the other way. So the first thing that you have to do, whether you're in the investment arena or trading, it doesn't really matter, is take a judgment call on both of those aspects. Which side do you really want to play? And it's always going to be a function of the larger degree trend. So even if I'm trading, if my larger degree trend is up, I would always prefer to be in the long exit bucket. And so that's very important, because people don't understand when you have a zigzagging market, why do you always sound bullish? You should turn bullish to bearish to bullish to bearish. Sometimes you're able to identify in advance that something's complete and it's time to do that bullish bearish switch. Sometimes it's not. And if it's not, then the judgment always falls back onto the larger degree trend. And so if the larger degree trend in your mind is still on one side, whether it's positive, then it's going to be bullish exit. If it's bearish, then it's going to be bearish exit. And so that's going to be just the mental setup that you're going to work with. And that's how you're going to really be on the right side. And once you change that mindset, then the entire approach changes. So that's about it. There are of course going to be different times when different people get different things right. So you can't really match yourself with the next guy and the next guy. Your strike rate is yours, his strike rate is his. Two people with completely different opinions at a point of time might still end up with the same performance, because they may be right at times when you're wrong, you may be wrong, they may be right. There may be times when both are right. But it doesn't matter, eventually it comes to a net outcome. What's really important is you have a methodology that drives it, a methodology that you can consistently follow over and over again. So it's more process driven based on what you've done over time and learned over time. And so it becomes execution oriented. And so I can't really get emotional about the execution, though in a place where you're in a public forum or when you're writing to other people, which is partly the business that we do with Indiacharts, because I'm writing a blog, I'm sharing my opinions. There is an emotional context where, people react to your changes in behavior, which I have to, deal with. So that is one additional emotional baggage that I've selfly decided to carry. And sometimes it requires you to have a head on to, take that on, because people will push back at you from different angles for being right or wrong at a particular point of time. The way you manage your book may be very different from how they manage their books. And that can end up in completely different results. People also join you at different points of time. So I can go back and look at, we turned bullish when the index was 7,800 is when I started to pick the long side. In fact, weeks before the pandemic, pharma was the first sector I really got bullish on. And but was not sure of the Nifty. Nifty, after it bounced to 78, I still thought it will fall. So I had a plan to buy every 500 point dip. It just didn't happen. But the fact that I said I'll start at least making an entry at 7,800 with the idea that if I buy every 500 points down to 65 or 6,000, I'll have a meaningful position, because the market was falling 500 points a day, which is insane. And that didn't happen and started to go up. But the good thing is, in psychology, if you're on a particular side of the trade and it starts playing out, it's sort of when you're rewarded. It's like being given chocolate to eat and you feel happy, and that's the same way the market works. If you take some position and if you're rewarded, then you're on the right side of the position. And so that's how getting bullish is also part of a process, and similarly turning bearish is also part of a process. You can get whacked if you turn early or if you're in the wrong sectors, and you have to therefore make those choices all along the way. So that's essentially what I've done. I think over the last 4 to 5 months, people have seen me sit through, I think, from 18,600 back to 16,400, then back to 18,350, then to 15,400, and then back to 18,100. And I couldn't get a sense that it was going to roll over, at least in October to December. After that, I thought there was a fifth wave pending. In January, the small cap index did make a new 52-week high, a new all-time high. And so that confirmed with what I was thinking. But again, I thought that the correction in the markets would be not too deep. And the reason to feel that was that many sectors were still holding up. And we've seen that performance into the March-April quarter, which is where you've seen new highs in everything from metals, oil and gas, energy, power, PSU, all of these sectors ended up with new 52-week highs. And so that sort of tells you that, yeah, the reasoning behind my thinking that when there's so many things looking positive, how can it really roll over, was partly behind it. And of course, the main thesis, which is the reflation trade. I've been hanging on to something called as the reflation trade since May, June of 2020, when I confirmed that yes, the dollar's topping out and this bounce in the market might be something bigger than just a retracement. Then, the sectors that we latched onto mainly was the front line was metal. The front leader was going to be metals and commodities, because a falling dollar would sort of trigger higher prices and an inflationary regime. All of that played out exactly as expected. The only hard part was knowing when does it end, because the Fed, yes, of course, had been making noise all of 2020 about interest rates to be raised. They were still not raising. Inflation was behind. They said it's transitory. Then they went into, okay, we'll do something. And all I had to do is keep looking at price till the point where I couldn't see prices roll over. And by prices, I mean commodity prices and the metal index. Having completed a 5-year advance, I couldn't really say for sure that this was done, which is what happened in the second week of April. So which is partly one of the reasons that helped me take that switch, even though there was so many gyrations before. All I was doing is every time it dipped, I was in the long exit bucket, right? So I was not playing the short side. So yes, people who think I should have sold at 18,600 and bought again lower, I was not looking at that as a short. I was looking at it as an exit, or sometimes thinking that no, it will still bounce back, may not fall so much. And because I was in that mindset, when it would start falling, I would just keep exiting as a risk management, rotate my portfolio into what is working, and then again write it back on the way up. But now to some people that's been painful if you're not being able to do that, and it does require, I don't know if it's luck, but it can be analytical, because analytically I was able to think that metals, oil and gas in these sectors will do well, or oil was still going up or had a fifth wave pending, which happened with the Russian war, that oil spiked and gave us that final fifth wave. And after oil started to cool off, we got spikes in aluminium, then nickel, and so all those missing fifth waves played out one after the other. And then I thought that, well, if these bottlenecks are going to be around, these prices may not come off easy, but they started to roll over. And only when I saw the Nifty metal index close down for the week after what looked like an ending diagonal is where I've taken that call that fine, if metals are done, then everything else is done. And that's what my Hindi Twitter video, which some people may find amusing and some people may find abusing, was really all about. So these videos are nothing but an act. I don't know why people should take it personally as an attack on anybody or anyone. I've been bull and bear over years. In fact, some people would say I was mega bear at one point of time, and many times. And the people who know me from really old back want to know when I turn negative. And this time I wasn't willing to. And if I did a Hindi video against the bears, they think that I was actually mocking them, when I have been in that camp more often than not in so many times in the past. So, but to me, these videos were really educational. If you go beyond what is being said specifically to a bull or a bear, I've only taken the same messages that you get in any particular book. Say, for example, I've just given the example. What would I do in a bull market? I would do long exit, which means in a bullish environment, your trade would be long and exit, which is nothing what I said in Hindi is that teji ke maal mein teji karo na, teji hai to teji karenge, mandi kyun karenge. And so that was the central message. Everything else around it was the act, which has been misinterpreted in so many different funny ways. But that's the good part, that that's how somehow these things similar to Instagram Reels get a lot of traction and people end up watching it. And it is nothing close to my personality if you haven't met me. So anybody gets too hot, I say you come and meet me. If you can't understand, if you think that this is an arrogant bull making video. And so by that very nature, once the in key indices that were making new highs rolled over, why shouldn't I turn negative? Even if it's 1,000 points off from the high. So you at 18,100 moment you started to fall. My cutoff point was a weekly closing below 17,280, which was the 20-week average. And that failure was so after a third attempt, so this is the point. You made 3 attempts in the Nifty to break out beyond that upper level of 18,600. And then after the second attempt, if you draw a trend line and the third attempt fails exactly at the trend line, it's a sign of a triple top. Now, either this triple top could have been a straight line, it could have been, it's downward slanting in this case, But mostly historically, I've seen upward slanting ending distribution pattern. So this was rare to see a downward slanting pattern, which also was the reason why I think I got confused of it being an ending top. I thought that if it's downward slanting, it's probably a consolidation before a new high. The new high came in several sector indices, but it did not come in the Nifty. And so that results in what we call an inter-market divergence. When over a 3 or 6 month period, after a significant move in the market, new highs in certain sector indices are not confirmed by the Nifty, or the reverse, new highs in the Nifty are not confirmed by certain sector indices, or there's an outperformance in, say, mid and small cap indices versus the Nifty. All these extreme situations happen at the end of a bull run or a bear run. You can see them at the bottom of 2009. The Nifty made its lowest point in October. It fell again in March of 2009. New lows in S&P, new lows in the Bank Nifty, new lows in the Nifty Mid Cap 100, not confirmed by the Nifty. So that happened now over how much time? October to March. So that's October, November, December, January, February, March. That's 5 months. And the same thing we are seeing here between the high in late October, or you can say early November, to all the way to April. Again 6 months, right? So if I take from the beginning, if I take November, December, January, February, March, that's 5 months. After 5 months, in the beginning of April, you're seeing a divergence with all these other sectors. So this intermarket divergence, where you have a non-confirmation between sectors, is as old as it's over 120-year-old theory from Charles Dow, who penned it down and said this is the Dow theory based on intermarket divergences between the Dow Jones Industrials, the Dow Jones Transports, the Dow Jones Utilities, and those indices are still there. And you did have an intermarket divergence between the industrials and the utilities in the same time, because utilities rallied to make a new all-time high in the month of April, which was not confirmed by either the S&P, Dow, or the Nasdaq. And so it happened in both markets. We had this massive intermarket divergence, and so that became the next signal that maybe finally this may be exhausting rather than a consolidation and a resumption of the reflation trade. We're finally exhausting it, and that meant that the Fed's policy to continue to push inflation down with high interest rates, which I was discounting as okay, it may not work because because of the Russian crisis and the sanctions, inflation pressures will be more persistent, which is still true. But the other part was, I didn't think the Fed would really want to go this far, which a lot of people still don't think. They think they won't go beyond 2 rate hikes. But given the bond market having fallen so far, I thought they would have backed off so far or started to support the bond market. So I said that in a couple of my previous videos, but it's beginning to look like they may or may not do that. Now today night, so this video I'm recording on the 4th of May, before the Fed speaks and after the RBI spoken. So I'm right in between two central banks. But the Fed will confirm whether they have gotten scared enough to back off from this type of policy. If they really back off and say, okay, we're not doing this, we're going back, then probably my pivoting is late and wrong, as some people are trying to fight with me over Twitter. But if the Fed doesn't do that, if they say, no, we still have to go ahead with the next 250 basis point rate hikes till we get this inflation genie back in the bottle, then we have a completely different problem, because that sort of almost will certify that the US is heading into a recession from what is already a significant slowdown. So, fights with inflation, by central banks are not completely new. I remember in 2008-9, in the midst of the financial crisis, we were already into a bear market by May of 2009, but commodity prices were still rising. So oil simply went to $135-$140 almost. And when it did that, I remember P. Chidambaram actually raised interest rates to get the inflation spike at that time under control. So it doesn't make sense. You're in the midst of a bear market. You have a recession coming in front of you. It would have been obvious to anybody. Why would you raise interest rates at that point of time to fight oil, which was a completely commodity cycle driven thing happening in some other place, not even your own market? Could your raising interest rates have really saved the situation over there? But those are not the parameters with which sometimes central banks work. And so that sort of explains what the RBI did today. As much as they've been saying we want to be accommodative, we want to support growth, which to me meant that they believe what the Fed was earlier saying, that inflation is transitory, it will go away, and we shouldn't just raise rates and slow down the economy. But they have a completely different problem. High prices of not just oil, but followed by that, many other items. Now I'm even hearing there's a coal shortage. India will have to import coal, and all of these imports at higher prices are putting upward pressure on the dollar. And there are only two ways you can fight that pressure. The RBI has been trying to intervene in the dollar market, sell some USD against the INR and keep that currency from moving apart. But I think right after I pivoted on the metals index, a couple of days in the following week, you had this spike in the dollar, which for the first time, so you know what, this is the other thing. People know that I've been saying dollar will go down. I was completely wrong, accepted. But I don't trade the dollar. I've been long equities, been long commodities, which are also going up along with the dollar. And commodity related currencies, which is like the Australian dollar, Canadian dollar, Chinese yuan, Brazilian real, all of these were strong against the USD. So the weakness in the USD was essentially coming, or the strength was essentially coming on the weakness from other currency pairs, especially the Japanese yen, then of course the euro, pound, and so on. In fact, the pound was also showing some degree of strength. But in this last spike, the other currencies which were not breaking, specifically Chinese yuan, had never weakened against the dollar throughout the dollar rally. 5 days it just went zap up, and so when that happened, and then it took the AUD, CAD, everything with it. And I think that became a warning sign that maybe the upward pressure on the dollar is now getting more broad-based. So initially it was like, ignore the dollar rise. It might just fall again. But at that point, I think I felt that maybe I should just not ignore it for the time being. And specifically in India, the USD INR is still not broken out of the range that it has been in for a while. So RBI still managed to keep a lid on it. But I think, so my thought of what happened today, it's not really been just about inflation, which was anyway there, and they were ignoring it. I think it is really about the currency. Because there are only two ways you can get your currency, to feel a little stronger. One is raise interest rates, and the second is sell your dollars. And there's a limit to how many dollars you're going to sell, because it's a national security question. And so, because you're going to need those dollars to buy the oil and the commodities that you're going to need, and the coal which they're going to need. And so the only way you're going to be able to deal with that is therefore raise interest rates. But unfortunately, raising interest rates in the short term also has the impact of sometimes slowing down your economy, specifically when it becomes dependent on the rate cycle. So there's a stage in the economy which is called the economic spring, which was way before for the US into the 70s, 80s, and India till the 90s, when that doesn't really matter. The economic cycle growth happens because of various other factors, from demographics to simply underlying growth coming from technology or so many other reasons. But in the autumn, the counter-type autumn is a growth phase which is often dependent on easy money policy, which means low interest rates, a lot of borrowing, and every sector does well because of the availability of money. And so that when you're in that phase, any hike in rates sort of pushes back on that cycle and has the risk of reversing it completely back into a deflationary environment. And so the back and forth on rates is essentially because of that. The US has been trying to manage it since 2009 that no, we will not go into that deflationary cycle. And having done that, they finally got so much inflation that they are being forced to raise rates again to control what is happening to the dollar and commodity part of the story. So this is in essence what has happened on the macro side. I think the moment I could see that the rising dollar was beginning to have an impact on other assets. So that's the right way to put it. Being right or wrong on the dollar is one thing, but the real thing is whether it was having an impact on other assets. The moment it did, I am forced to flip and go into a risk-off mode. So let me put a timeline on this. I think it's 22nd in fact, I should say a week before that. So around 18th, I think I turned bearish on the IT sector. And when I did that, I thought that wave C down, if such a big significant sell-off in the Nifty IT occurs, then even the Nifty has to roll over, because it's been one of the biggest gainers in the set of indices that are there in the market now, and one of the drivers, and it has huge weightage in the Nifty itself. So that was my first warning sign, but I was still not backing off till the 22nd of April, when the Nifty Metal Index finally completed an ending diagonal in a fifth wave. So I was thinking maybe this is just one of five, this will go on longer. But the ending diagonal is a warning because it only occurs in fifth waves. For a while, in fact, I even thought, is it a leading diagonal? So that was the bull inside trying to, still say, oh, remain bullish. But I gave in. I said, fine, if the ending diagonal is breaking down for once, let's turn negative and go into risk-off mode. Following Monday, I wrote a strategy note explaining to subscribers that wave C down in the Nifty of Z can be brutal. If it turns out to be brutal, then wave C, usually it's only cash that works. And the reason is that every sector which was doing well, okay, so if you had some sectors you were hanging on to which was balancing your portfolio or even giving you positive alpha, when you reach this point where you've got triple top and you've got all the indices peaking out, suddenly you have a situation where maybe all sectors roll over and everything falls together, so you don't get that performance alpha anymore. And that's the point we were getting at, which is the risk of everything going down together. And in that environment, then only cash works. So that was the strategy note. I didn't write a detailed long short report because time was less and I wanted to really get the message out. And so starting that Monday, between that entire week, I think I've posted it on Twitter, we were going from 30% cash on that Monday to 50% by Friday and 60-65% in the last few days is part of the risk management process, and doing that at a portfolio level for a lot of people is difficult. I've probably done it many times before. I always hate doing it because I always think that, I should act like a 5-10 year long-term investor and never sell. And if I see an index correction which is only 10-15%, I might not bother, because if you see from the height of 18,650 down to 15,400, if I didn't turn bearish, it was essentially just 16 to 18% correction. 16% I think it is from the high to low, if I'm not wrong. And that was still okay and there were some sectors holding out, so that sort of kept the confidence that fine, it's a routine correction, you hang on to it. But if everything is rolling over, and specifically looking at the US market and the way US stocks are tanking, the bigger risk is, have we really pricked a 12-year long bubble that started in 2009 all the way into 2021? In fact, Jan of 22, I should say, where the peak of US indices is. So that's a really long period of time. It's maybe 12, maybe 13 years. So after 13 years, and that's a Fibonacci number, you finally hit a peak that might have pricked a bubble because of the way you're seeing the FANG stocks roll over, and a lot of the tech sectors, the new age companies, as we may call it, have crashed. That's usually not a good sign, So I think while all that, now you can completely say that you should have noticed that happening and changed earlier, but that was happening in the US market. It had still not played out completely here. So I think I took a while. I agree, I took a while, but fortunately, because our indices held on longer, it has given me that opportunity, or we would have to really have flipped on a lid earlier, so then it would have been a big miss. But having said that, this is life. This is where we are. I don't feel I've been too late on it. I did feel bad about the October to December sell-off because there was quite some damage there, not at a portfolio level, but damage was more on a trade management level. And so, but then there, I was also partly affected by being ill, so I took no decisions which I should have when I was, when you're in a hospital, you don't know. I couldn't really think what to do. But I think I had an idea what I should have done, but I didn't pull the triggers. So that's my own mistake in managing there. But then it could. What I'm trying to then say, it still could have been done, because from the December low to the Jan high, we had a clean slated rally from 16. In fact, 16,400 to 18,300, which and then again in April. So you got multiple chances, to make it back if you really were focused on it. And that's the level of focus. I think if you want to be in this game, you've got to have that focus. If you're not that focused, then you have a completely different problem. If you wait very long to see whether something is right and then participate, it doesn't work that way. If you don't have a system that tells you when you need to be against the market and when you should be with the market, that's another problem. Because when someone tells me, you're bearish, I lost money, I'm like, first of all, I'm not giving anybody any advice. But frankly, if you're just going by my view on the markets, if we turn bullish at 7,800 and then I'm turning bearish at 17,100, missing 18,000 on an investment portfolio basis, forget the trade part of it, then I think the only reason you're feeling pain is you probably came in very late into this party, so that's a different problem. You get convinced at 15,000 that, oh shit, I should be in this, and then at 17,000 you're still in the wrong stocks, and so the small caps you bought completely got blasted, and then I am to blame because I was still bullish. I mean, come on, I don't take that kind of blame. If you're not with somebody through an entire, we call it the cycle, right? I always talk about momentum cycles, and we talk about the commodities cycle, which is a 50-70 year cycle. Momentum cycles can be of any time frame. The daily cycle lasts for several weeks, the weekly one lasts for several months, and the monthly one for several quarters. And depending on what time you want to be, you need to be in each part of the cycle and learn how to do that. So that is essentially what we try to train people on in the mentorship program. So what do we have since Jan, Feb and March? We slowly had a rollover in the quarterly markets closed down at the end of December. First warning sign, monthly momentum indicators crossed to the sell side. And in the last month, you have all three aligning, daily, weekly, monthly, everything going into sell. And so that's sort of the alignment. What we're trying to then check is whether there's a bigger risk in the market, and whether right or wrong, it doesn't matter. Say it doesn't fall that much. Okay, it only goes down to 15,000, the 20-month average, 15,400. Worst case scenario, everything comes back. Fine, great. You manage risk, you get back and participate, no problem. Again, going back to my main point is the US market, the way it has turned, is beginning to look like a bubble, popping because of all that easy money, and the Fed being pretty much on that path. And you come to know tonight whether they're going to stick to it, or they finally, gave up or got scared enough to run away. And if they're not running away, because a lot of people, especially those who are politically inclined, are saying that no, they're not going to run away because of the midterms. And so they're going to stick their guns. We're going to get a recession first. And if that's happening, then US equities are not going to recover easy. And that's going to rub off on the rest of the world. And all markets, which are all the emerging markets, which have impulsive rallies, where you can see a 5-wave up move like in Taiwan or in Brazil, what ends up happening is that you end up with a deeper wave too. So it looked like to me that a 38% retracement in Brazil was good enough, but it rallied in 3 waves and started to fall again. The rally was sharp, got a quick 30-40% move in the Brazil Bovespa index. But then it lost that momentum and started to fall. Many people have, gained by taking that trade. Some have exited, maybe some have not. But the sell-off proves that it was a counter-trend bounce, and now it's into another sell-off. So that then can go to 50% or 60% retracement is what I'm sensing, and same is the risk in India. So people are asking me, can this be a deeper sell-off or correction? My simple answer is, the risk I didn't perceive was there earlier, but now I definitely perceive that's a risk. If it doesn't happen, great, but the risk is there that it happens, and you need to position accordingly, because if you do get a 61% retracement, which means going back to 11,800 or something like that. So if you're talking 12,000 or sub 12,000 on a 61% retracement, that's pretty deep from here. Even if you do 50%, you go back to the fourth wave of previous low, 14,800, something like that. It's still quite a bit. Okay, you may feel that okay, that's not much lower than where we were at the last time. Maybe bearable. But what I'm saying is, the risk now is there that it can get worse simply because of how the global macro is panning out. And if we continue down this path, US hits a recession, you get huge unwinding of margin trades. We really don't know how deep those can go. And so markets have the habit of overshooting on both sides, right? On the upside also they overshoot. You get intermarket divergences, and then the same thing ends up happening on the other side. We overshoot to the downside, you end up getting panic. And so till we really get to that point, I think it's time to just manage risk again. Yeah, that hated word. People are increasingly hating it, and probably hating it because they're long and can't exit. But I've learned to do it both ways. Once I decide I've got to do it, I'll do it. And I can do it the other way as well. If I feel that things are fine, I can participate on the upside again. What's wrong with buying 10% higher? There's absolutely nothing wrong. But losing 50% down, if that is a risk, then you might as well hedge against it, even if it involves paying a 10% tax. That's my way of thinking. People bring in even the tax angle. Oh, I'll have to sell and pay that 10% tax. So it's better than losing 50%. And then it'll be like, oh, but are you sure it's going to lose? If you're sure about anything in life, there would be, you would have no probabilities. The only thing you can be sure of whether the risk is on the table or not. So if you feel the risk is not on the table, fine, don't do it. But if you feel the risk is on the table, it may or may not happen. But if it's on the table and it does happen, how prepared are you? And so you find a way to get prepared, whether it's going cash, hedging, I don't know what strategy you know how to follow, where you think selling call options every month in what is also known as covered calls is a strategy that can bring down your cost of portfolio. And see, what are you good at doing? Okay, if you're good at doing that, you do that. If you're good at doing an exit entry, you're good at doing covered calls, you're good at doing Nifty hedging. I don't know what works for you. And I can't know, because that really involves sitting down and looking at each one's portfolio, whether you're doing 20-80, are you doing 80-20, and by 80-20 I mean, are you doing a large part of your portfolio is trading or a little part is trading, or you're very small size and you do only a few puts. And that's the reason why I don't want to be an advisor, because the first thing, moment you're a registered advisor, you have to do a KYC for each client, and you have to know all of this. Without doing that, how can you really tell somebody to do something in any particular market without having a proper KYC of the customer? So that's completely right. I don't know how detailed everyone does it or not in existing advisors, but it's a mandatory requirement. And so I can't give anybody any particular advice. I can only tell you this is what I'm doing. I mean, I do 80-20, where 20 is trading and 80 is investment. I've done higher ratios before, but those were when you were at a smaller capital size, so you choose to take a higher risk. And sometimes when your trading gains increase, you get tempted to take a higher risk, and I do, and sometimes you get whacked, which is sort of what October was. And so that's part and parcel of life. As long as you have rules and you have a methodology to ride around it, you'll still be there. You'll still be there with a positive return and a long enough period of time in the markets. I've been here for more than 30 years, so nothing to really crib about. And I'm in fact doing everything for myself. So if I don't advise or help anybody else in terms of direct managing of money for someone else, no family offices, nothing. I have the only one thing to do, which is manage my own. So that's what I do. What serves me best is using this platform, my blog, Indiacharts, the apps, all of them, is just to communicate what I'm doing, why I'm doing it, so that people can learn from it. So for me, it's purely educational. People better get a hang of how to manage things, and risk is always there in the markets. There are times when you don't have to manage risk, you have to just stay on one side, and there are times when risk management is the only way, because whenever you're in a zigzag market, so just remember this, I've done this performance analysis so many times. Every zigzag market, whether you're a short-term trader, positional trader, whatever, your strike rate comes down, you get a drawdown. Okay, and so drawdown management is the only ways you manage risk. How do you manage risk? You reduce the number of trades, you reduce the amount of positions. You still keep taking positions. So I don't say you stop trading altogether, because you don't know when a market will go from range bound to non-range bound. If you could know that, you would be God. I mean, nobody's been able to figure out it. All these automated models, they have no idea when to go from trend following to non-trend following. So they come in and do a manual interjection. Okay, everybody manually intervenes in their automated models because they want to figure out when is trending and non-trending, and so there's always a human aspect involved for that. And so because you can't know that, okay, the only thing you can do is when you start taking hits is you reduce the position sizes. Okay, you come down, you instead of 5 trades, you take 3. Okay, you take 2, or you stick to only one index or one sector or something like that. It sort of allows you to manage better. Till the point of time where things start playing out and it becomes obvious that, yeah, this is what was happening and this is exactly what I should be doing. And then you increase position size again. So this is something you have to go back and forth to doing. And that's about it. So that's, I think, just what I had to do for the last several months. But mostly with a long exit side. And now I've completely pivoted to the opposite, which is, it's, I think, going to be more of a short exit market. And hated to move out of a lot of the investments, but I've just done it because this is wave 2. Wave 2s tend to be, if at all, the deepest retracements in the market. It could have been 23-30%, but the way so many sectors are peaking out and the policymakers are continuing to aggressively move towards higher interest rates, if this is just the beginning by RBI because they've said they've taken away accommodative policy, then by the time rates are raised, then inflation comes down, then interest rates are reduced again to stimulate the economy, and then actually a stimulation happens and things start to improve. It may take months for that cycle to play out. So you have time now on your side to decide exactly how and when you should go about doing it. And therefore it's time to go into risk off mode is what I thought, because it's wave 2. It can end up being deep and it can end up taking time, which will give you enough time to think about these things. So that's I think in a nutshell where I am on this whole thing. And yeah, it's wave C of Z, or at least if it's not C of Z, it's that last it's that phase where you've transitioned from, if you've completed that intermarket divergence, it's the cash stage, where cash is the only thing that wins. Whatever you'll try to buy, will not work, and the market is still not oversold. So you're not even at a point where it will bounce. And in fact, oversold readings also won't work, as we've seen in the bond and dollar market at so many times sentiment extremes which have not been working. And so if those sentiment extreme readings are not working in the dollar and bond market, they will also not work in the equity market. You'll have to wait for structures. So you'll have to wait for sentiment and a particular wave structure or pattern both to come together before you can make a clear-cut call that, okay, I at least going to bottom here and bounce. So that's going to be very difficult to call the bounces. And the bounces are ending up being very, very small, as we saw even in January. And now we are seeing in this particular fall, all the bounces last week. I thought there could be a 61% retracement of the initial decline to 17,600. We didn't even cross 17,400 or touch the 20 DMA. Came close and then just went off. So when you're not getting bounces, it's a very, very weak market is what it's beginning to look like now. So you have the peak in commodities. The commodity cycle is gone, but not the long term, not for long term. When I say it's gone at a weekly or monthly degree. It's also going to be a wave 2 correction. So we're going to get a deeper cut, and we're going to wait and see how that happens, how deep or what. But wait for it to happen. This may just be the first backing off. I'm sure once everything happens, like you get to a US recession or whatever, what will you do next? You again have to stimulate. You have to go through this whole process all over again. So you'll get a deep wave 2. Again, you'll start the next wave, which may hopefully end up being wave 3. Is going to be the big bet. The whole point is going to be timing that point, knowing when you are over there, and that's what we're going to be trying to be on top of. And till that point of time, I think let's just remember one last thing. I've already spoken about RBI. RBI has raised rates and started on that mode, raised even the CRR ratio by 50 basis points. So that's sort of going to affect all the interest rate sensitive sectors, whether it's housing and banking. But in banking more where bonds are there. I don't know about the lenders, but definitely places like autos that depend on people buying through borrowing. So those sectors again get a drawdown, and so that's as far as RBI is concerned. The last part is the model. I don't know if you've noticed, and so that's the Martin Pring model, which I've shown in many times in previous videos. So I'll just highlight it before I leave you once more. This is how you get a cycle between bonds, equities, and commodities. So it's always the bond market which is first to bottom or top out, followed by equities, followed by commodities. So what happens? Interest rates start to rise. So when they start to rise, the bond market is falling, and it's falling simultaneously with equities going up. Okay, so you have the first market which is rolled over, which is the bond market. Then eventually equities peak and they start rolling over because bonds fell too much. Okay, and then equities and bonds both fall together. Now, it may at that point of time look to people like there's stagflation, but it's nothing but a rollover process. Stagflation is a very, very different scenario. I don't think we are in, I still don't term where we are in right now as stagflation. So you can argue as much as you like. But to me, it is a cycle. So what is the third one that happens? When equities fall, commodities still continue to rise for a while longer, and then commodities are the third one to peak. And so when all three peak is when everything rolls over and then you get a drawdown. And then again, the same thing repeats on the bottom end, where bonds are the first to bottom out, which is what we're going to wait for. When bond markets start to rise, which means interest rates start coming off, the bear market's not necessarily over. Equities still decline for some time, then they turn around, and then eventually it's the commodity market that joins. Now, sometimes because market bottoms are panics, you might find equities and commodities bottoming closer to each other at the lows. But at market tops, more often than not, there are divergences. You go back and look at 2008-9, US equities peaked in October, India in January, oil, June. So months later, you had the commodity cycle still make one more spike up. Of course, copper maybe not make a new high along with oil, but oil was the last one to spike. And gold, in fact, peaked in March of that year. So that also much later than equities. So that's how it happened. And so even right now, we've seen the same thing where, equities in US January, in India, you can say October, you can say based on the rest of it that it's only happened now, where all sectors peaked out is April. And now you're seeing, and which is where commodities have happened. So actually commodities, so in terms of the high, October for India, January for US, and now you have commodities in April. So now you have all of them roll over, and now you're at the point where there's no place to hide till first the bonds bottom, and then after that equities, and then commodities. So this is just a cycle to understand where you are, and this cycle is I should give credit to Martin Pring for putting it out. in his books and his works over here. So that's where I saw it, and so I give credit to where I always find something. I don't have to own up everything, as something of mine, except what I did do is map the quantitative cycle to the Indian stock market, which I take credit for doing on my own, and putting out my own momentum indicators for capturing momentum cycles at across time frames, which you can now use on the Trade Tiger Sharekhan platform. So this is all the stuff that I'm doing for people who don't know, and that's my market outlook now. A completely changed scenario. I've had to flip. If you haven't been able to, you think about it. It's finally something that you have to learn to do yourself. It's not something that anybody can tell you to do. It has to be based on a system methodology that you believe in. And a lot of people get inactive both on the way up and on the way down in markets, which has nothing to do with anybody else's opinion. It has to do with something known as behavioral finance, which is a completely different subject on human psychology, how we take decisions, and why we are not able to take certain decisions at certain points of time. Everybody has behavioral finance problems, including me. I have my own, and the way we work around it is we develop processes or systems that help us overcome those problems as and when we face them. That's the only way. You're not going to overcome all of them, but first level is awareness. So once you're aware of which problems you face, then you build a structure and a system to deal with them. That's really an essential part of the whole process. I mean, I can learn the science of markets, and I can learn how to execute, and then once I've learned all of that, I'm going to have to overcome my own behavioral finance problems for being successful in the markets. So that's what I'll leave you with at the end of this long discussion on the market, and continue to follow me on Twitter. Not only like these videos and share them, so the moment you like them, a lot of more people come to know about it. So go ahead and like it if you enjoyed hearing what you did, and if you think there's that crazy guy on Twitter, I'm not that guy who's making those Hindi videos. I'm someone else. That's just an avatar. Thank you.
Hello, I'm Rohit Srivastava, the founder and strategist of Indiacharts. After spending 30 years in the world of stock market, I have built a comprehensive mentorship program that will enable you with the right tools to start investing. With this program, you're going to get lifetime access to all live sessions, case studies, discussion forums, and a chance to get certified by Indiacharts. And here's the bonus. You get lifelong mentorship with Indiacharts. Need more details? Download Indiacharts app now and start the process of learning. See you in class.